Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. In a rather slow market domestically, the global markets continued with its stream of data, starting with the Eurozone's preliminary inflation figures. The year on year figures rose to 8.5% against 8.2% expected. While the rising interest rates have continued to take its toll on businesses, yesterday we heard the news that Blackstone has defaulted on a $500 million bond backed by Finnish offices and stores as rising interest rates take a toll on the property market. JK, good morning. Take us through your updates. What are your thoughts on Eurozone inflation? Is more rate hikes on cards?
Yeah, I think despite the headline inflation coming a tick lower than last month, but it was definitely higher than market expectation. And the services and wage inflations have been putting a lot of pressure on the inflation in the Eurozone. And the yields definitely reacted higher after that. Now, but there are some analysts who expect the Eurozone inflation to ease in the coming months, possibly the base effects and the oil price impact to show up as we read the inflation for March onwards. That's more on expectation, but ECB always goes by the current numbers, and their rates will go up by 0.5% in March, and possibly another hike, the quantum to be formed up later, but there will be another hike in May as well. The minutes of February ECB meeting, which is it's clear that they want to continue hiking rates beyond March meeting. Then of course we had the jobs weekly jobless claims from the US again coming lower than expected, coming lower than last month, albeit a small decrease, but definitely confirming that job market continues to be strong. And of more concern to the policymakers would be the overall wage pressures that is increasing in the US as depicted by the quarterly labor cost data, which came at 3.2% versus 1.6%. In fact, what is being observed all over the global major economies is that price growth remains stubbornly high, and the wage inflation is making a bigger contribution to this. Report says that more than 340,000 Americans will see an increase in their monthly paychecks after Walmart, the biggest private sector employer in the US, raised its minimum hourly wage to $14. And on the other side of the Atlantic, UK public sector workers have taken industrial action over pay. Germany's public sector unions are also calling for strikes. Even in Japan, where many people have not had any pay rise in decades, have big players are being shake up and seniority-based salary structures that could put more money in workers' pocket. So while you may have the supply side issues easing off and goods inflation moderating, these wage pressures on the upside will add to the demand, and the inflation is likely to be elevated. That's why Fed keeps hopping on the higher for longer theme for the for their policy rates. On the also on the data side, China recovery post COVID restriction removal has not been disappointing at all. After a better PMI manufacturing number on Wednesday, services sector expanded at fastest pace in 6 months in February. And that augurs well for the risk sentiment. In fact, it has shown up in Asian markets as well. Fed's Bostic made important statement that he will stick to 0.25% hike, and he in fact mentioned the slow and steady approach as appropriate course of action for the Fed. So Bostic's statements actually moderated the yield rise somewhat, and got support for the stocks as well. Some in the market reading that Fed will not go far beyond 5.5%, Therefore, there has been some bit of value buying in the stocks. In fact, we are observing that the gap between market expectation on rates and official speak have actually shifted to the other side. While even most hawkish Bullard wants rates to be somewhere near 5.38% as per his statement recently, market is firmly in the camp of 5.5%. And the common ground is that both camp think rates will stay higher for longer. The monthly payrolls and consumer price data in the coming days will obviously offer more clues on how aggressive Fed may go when they meet on March 21st and 22nd. Of course, the expectation is firmly for a 0.25% hike in this meeting. As one would expect, dollar moved higher along with the surge in yields and then correcting back after Bostic's somewhat sobering statements. Expect dollar index to be confined to 103.50 and 105.50 in the lead up to next week's important data. Euro fell back after the inflation data as market had already discounted a high number. Sterling has lost a bit of direction as it meanders in ranges. Policymakers' statements have been actually seen on both sides. On the rupee, it's heartening to note that there is a slight shift in bias towards a stronger rupee because there has been some bout of inflows in the last 1 week or so. We are firmly trading below 80 to 60. In fact, offshore market right now shows below 80 to 50. And there's a lot of it is due to the seasonal factors as well, because the financial year end brings in bunched up inflows and exporter hedges actually gets elevated because of the balance sheet purposes. But there are also some positives for the rupee or the economy from the point of view of investors. Moody's investors raised India's economic growth estimate for calendar year 2023 to 5.5% from 4.8% pegged earlier on the back of a sharp increase in capital expenditure in the budget and a resilient economic momentum. And we are also seeing a step more towards rupee trade settlement. And as per Reuters report, UAE and India are in technical discussions to finalize a rupee dirham exchange rate for trade arrangement, and that there has been an agreement to settle certain amount of trade between the two countries, not involving a third currency. Also importantly, UAE wants to be part of India's energy security, while they look to India as a partner in food security. So overall, sentiment towards the rupee somewhat better, at least for this month. Also, the ruling party at the center, gaining back seats in the northeastern states is possibly this, a start of positive political momentum for continued stability in India's political setup. That's good for the rupee from the long-term investors' point of view. Thank you.
Thank you, JK. And just to summarize, Eurozone inflation came in higher than expectations. Services and wage inflation has continued to put pressure on the Eurozone inflation, while the minutes of the ECB meeting make it clear that they want to continue with hikes even post-March. From the US point of view, we had the weekly jobless claims, which came in lower. And even there, the labor market continues to be tight. So basically, a theme which we are noticing is that advanced economies are seeing tight labor markets, whether it is in US, Europe, or even Japan. Interesting change in rate expectations of market versus the Fed. A few months back, markets were pricing a lower terminal rate than the Fed's expectations, while now the scenario has reversed with market pricing in a higher terminal rate than the Fed expectations. While domestically there seems to be a shift in the bias for rupee, as we are seeing some strength due to inflows and a broad stable macro picture. That's it for today. As we keep saying, keep managing your risk. Have a very good weekend. We'll see you all tomorrow next week with another round of fresh updates. Thank you so much.